Anyone can build wealth and pass it on to their children, grandchildren, and great-grandchildren by starting early and making smart decisions over the long term. But how do you begin? And how do you grow your fortune while keeping the risk of losing it minimal? The good news is that there are plenty of ways to build generational wealth, even if you start late in life or don't have access to a fortune at birth. These 7 tips will help you get started building generational wealth with some smart financial decisions. Hello everyone, welcome back to Fascinating Self. Now, let's get started. Why is generational wealth important? If you are starting from scratch with your finances or starting out with a large debt burden, then you should realize the importance of generational wealth. What if your parents had the ability to fund your college education? This single action could have a tremendous effect on your financial future. Instead of playing catch-up to pay down your student loan debt, you could be saving for your first home or your future retirement. As you continue your personal finance journey, you have likely discovered that it is not always easy to recover from your financial mistakes. What if your parents had been able to offer solid financial guidance as you stumbled your way through? It could have prevented spending beyond your means or started you on a budgeting habit much sooner. The more you think about your financial life, the more you realize how important generational wealth can be. If you have kids or plan to have kids, then you may start to think about how their financial futures will play out. Imagine how differently things could turn out if you take the time to educate them on personal finance and set up vehicles to add security to their financial future now. So let's get into how to create generational wealth. Invest in your child's education. Raising financially independent adults is important if you want to build lasting wealth. You can help your kids create a path to support themselves by teaching them about personal finance. Giving your kids a financial education is one of the most important things you can do to start building generational wealth. It starts with having open conversations about money at home so your kids know they can ask questions. We need to have daily conversations about money with our children. The subjects we need to cover range from needing, wanting, earning, and the importance of saving and giving. As children grow, we need to plan to introduce them to more advanced personal finance concepts. As we learn and discover new tools, we need to incorporate what we learn into our children's education as well. Our goal is that they are equipped to be financially responsible adults by the time they leave the house as young adults. It can be intimidating to take on that task, especially if you're figuring out your finances. But most people learn from their failures than their successes. The same applies to money. Children can benefit from our financial wins, but they can also benefit from our financial mistakes. As parents, we can shy away from talking about our failures and what we did wrong. But sharing our losses and what we learned from them, we can help our children avoid some of the mistakes we made. Number 2, investing in the stock market. The second tip we give is to invest in the stock market. There are many assets you can invest in. To better understand your net worth, that is, your assets minus your liabilities, you might consider signing up for Personal Capital's free financial tools. Millions of U.S. households use this technology to see all of their financial accounts in one place and analyze their investments all for free. Investing in the stock market is a passive way to build wealth and protect your money from inflation. Most people who invest in the stock market with a long-term plan and diversify their portfolios make money over time. On average, the S&P 500, which is an index that tracks the stocks of 500 of the largest U.S. companies, has returned an average of 10% before inflation since 1926. Investing in the stock market can be intimidating at first. So, as a beginner, an easy way to get started is with low-cost index funds, which offer long-term growth opportunities at relatively low fees. Invest in real estate. In addition to cash and stocks, real estate can be used as an investment vehicle to build generational wealth. There are several ways to do so, but let's talk about the Real Estate Investment Trust or REITs. REITs are basically portfolios of income-producing properties that investors pull their money in order to own a piece of. When you invest in an REIT, you own stock in it, which means you get its quarterly dividend payouts and any gains from selling your shares at a higher price than what you originally paid for them. Some of the most popular REITs include healthcare, retail, industrial, and lodging properties that generate passive income for shareholders. Simply put, it's like earning interest on your bank account. And since they're publicly traded, REITs provide instant diversification because they typically have hundreds of holdings. This is great news if one property goes belly up or experiences some kind of a hiccup. And unlike individual properties that might go through periods where they don't produce much income, REITs typically have high occupancy rates and stable revenues that make it easier to predict future earnings potential. That said, there are risks involved with investing in any type of asset class, including real estate. However, if you're looking for a long-term way to invest in property without having to manage or renovate anything yourself, then consider buying into a well-diversified portfolio via an ETF or mutual fund. Another option is to buy a stake in a single property by going directly to its owner or developer. You could even work out an arrangement where you become part owner of the building and receive monthly rent checks until you've made back your initial investment plus additional profit. If you take that route, keep in mind that ownership comes with additional responsibilities such as managing tenants, paying taxes and insurance, etc. So, make sure you understand all of those costs before signing on the dotted line. Create a business to pass down. More than 30% of family-owned businesses are estimated to have made it to the second generation. So, building a business to pass down to your children is another way to build generational wealth. For anyone interested in passing down their businesses to their children, it's a good idea for them to start working in the business at a young age. It can help encourage them to take over the business. However, if your children are not interested in running the family business, there's still the option to create wealth by selling the business. You could then use that money to invest elsewhere or live off of it. If you choose to sell your business, don't wait too long. Studies show that an owner's value declines significantly after he retires from his company and continues declining every year after he stops working until his death. In fact, an owner's value typically drops 80% within 5 years of retirement. This decrease occurs when owners stop working in their own companies, they lose touch with operations and may no longer understand how much cash flow is available from sales and where those sales are coming from. Therefore, it is important to maintain active involvement in day-to-day operations, as well as on projects requiring substantial funding such as expansions and new facilities or equipment purchases until you retire. Take advantage of life insurance. Life insurance is a great tool to pass down wealth. It provides a safety net for your family if you were to die unexpectedly. If you have children or dependents who rely on your income, their financial situation would be negatively impacted by an eventual passing. Term life insurance can be an affordable option to ensure that your loved ones would be financially cared for if you were no longer here to provide for them. Losing a loved one is difficult in itself. Alleviating the stress by making sure that they are financially secure through a life insurance policy will help them focus on grieving. So, it's important to get quotes when your health is best. When it comes to how to build generational wealth, creating multiple streams of income can make it easier. In fact, the average millionaire has 7 streams of income. There are a variety of income streams, but one of the best known is passive income. Active income is when you trade time for money, such as a job or a side gig. Passive income is when you earn from your assets after the initial setup without much time. For instance, rental properties, book royalties, peer-to-peer lending, etc. So you do have to put in the work upfront. But once the initial foundation is laid, you continue to earn from your efforts. So you could write a book and continue to earn income on the royalties years later, or buy a house to rent out and make rental income. Start setting up passive income streams to build generational wealth. Set up custodial accounts. Custodial accounts are important vehicles for any financial legacy that you hope to build. Custodial accounts are investment accounts that you can control for your children until they are no longer minors. In most states, they receive control of the account at age 18, but in some states, they have to wait until they are 21. You can fund these accounts for your children for future financial goals, such as paying for college or buying their first home. However, they may have to pay taxes on this money as they withdraw it. Another option is a 529 plan. It is a tax-advantaged savings account that is tied to paying for your child's education costs. These plans are state-sponsored ways to efficiently save for your child's future. There are pros and cons to each option, but you'll need to determine which is the best for you and your family. So folks, this is the end of the video. Let us know in the comments if you want us to make more videos like this. Don't forget to like and share this video if you like it. See you in the next video.